West Ham owe other football clubs almost £196 million in transfer fees while playing in the Championship. That sounds like somebody has found a bill under David Sullivan's desk and realized payment was due last Thursday. The reality is more complicated, although I am not sure it is more comforting. The £195.8 million appears in West Ham's accounts as player-related creditors at 31st of May, 2025. These are transfer fees the club had already agreed to pay in installments after signing players. Around £110.9 million was due within 1 year, and another £84.9 million after that. The whole amount was never scheduled to leave the bank on one morning, and the figure is a dated balance sheet snapshot because West Ham have bought and sold players since. Still, it reveals the financial inheritance carried into the season that ended in relegation. Every agreed installment remained payable when West Ham dropped into the Championship in May. Wolves do not reduce the Max Kilman fee because the buyer now has a fixture against Charlton. Relegation changes the income available to meet old promises. It does not rewrite them. That creates the question behind this situation. What happens when a large Premier League club builds its costs around Premier League money and then loses access to that money? West Ham entered the problem from an uncomfortable starting point. Their latest reported turnover was £227.6 million, yet they made a loss before tax of £104.2 million. Employment costs were £175.9 million, while player amortisation reached £99.4 million. The club was already forecasting a possible cash shortfall in summer 2026, under assumptions that included Premier League survival. Its accounts said relegation would require player sales, wage savings, shareholder funding, or some mixture of those. In software testing, we call that a severe but plausible scenario. In football, they let the scenario play 38 matches and then act surprised when it reaches production. The first thing relegation removes is Premier League broadcasting money. West Ham recorded roughly £132 million of broadcasting income in their most recent accounts. Estimates for their first Championship season put that stream at around 45 to 50 million, including the first parachute payment and EFL distributions. Something close to £80 million can disappear from one revenue line, while the club remains responsible for transfer installments arranged during richer seasons. Parachute payments soften the landing by giving relegated clubs a declining portion of the Premier League's equal broadcast share for up to 3 years. West Ham's first payment makes them wealthier than most Championship rivals, yet it cannot reproduce top-flight income. A parachute is useful when you fall out of a plane. Nobody lands and complains that it failed to provide business-class seating. The wage bill should fall, because BBC reporting says most West Ham players have relegation clauses triggering significant cuts, reaching 50% in some contracts. Departures can remove more salary, although another club must want the player and accept his wages. Staff and training ground costs continue, while player amortization usually continues until a player is sold or his accounting value changes. This is where cash and accounting begin arguing. The £104.2 million loss does not mean exactly £104.2 million in cash vanished during that year. Amortization records the cost of earlier transfers across player contracts, while the fees themselves may be paid across several windows. A club can report a huge loss and still meet today's payments. It can also report a profit on a player sale while waiting years to receive all the cash. The dangerous part is the calendar. West Ham had £204.3 million of total creditors due within 12 months at the May 2025 year-end, including £110.9 million of player commitments. Those dates must be matched against broadcast distributions, season ticket receipts, commercial income, sale proceeds, and outside funding. Relegation cuts the largest dependable inflow on that calendar. West Ham can close the gap by reducing wages, selling players, borrowing, or asking shareholders to supply money. Each choice solves one problem while creating another. Selling a valuable player produces an accounting profit when the price exceeds his remaining book value, but the buyer may pay over several seasons. West Ham can wait for those installments or receive cash early from a finance company at a discount, a method their accounts show they have already used. It improves today's liquidity by sacrificing part of the future amount, rather like paying to receive your salary before payday, except your salary is Declan Rice. Borrowing also pushes pressure forward. West Ham arranged a £124 million facility with rights and media funding, and has a Barclays overdraft facility. Interest and repayments then claim future revenue needed for football operations. Shareholders could supply equity, or they could use loans and expect repayment. The squad complicates every decision, because the players most useful for winning promotion are also easiest to sell. Keeping them improves the chance of recovering Premier League income quickly. Selling them creates the cash needed to fund the attempt. A finance director may see an £80 million offer as liquidity, while the manager watches his best chance of finishing in the top two walk away. London Stadium adds another layer. West Ham play there under a long concession and do not own the freehold. The deal gives them a huge ground for a relatively modest usage payment, while the public owner carries substantial operating responsibilities. Ownership would provide collateral and more control over the building's income. West Ham cannot mortgage London Stadium, and revenue from concerts or other events generally belongs to the stadium operation. Catering and naming rights are governed by contractual shares. In the Premier League, broadcast money made that limitation easier to live with. In the Championship, every commercial pound matters more. The pleasant part of renting is that somebody else handles structural repairs. The awkward part arrives when you need to raise money, and the most impressive building associated with your business belongs to the landlord. Does owing £195.8 million mean West Ham are about to go bankrupt? There is no evidence in the published material that the club has stopped paying transfer installments, and the gross figure alone cannot answer that question. Large football clubs routinely carry transfer payables because installments are how the market operates. West Ham also have valuable players, substantial commercial reach, a huge supporter base, parachute income, and shareholders capable of supplying finance. Those strengths give the club options that many championship sides would love to have. The warning comes from seeing all the obligations together. The May 2025 accounts recorded a £104.2 million loss before relegation, a summer liquidity shortfall under the base forecast, expensive financing, and almost £196 million owed on past player purchases. Another season of squad investment followed before Premier League income finally disappeared. Immediate promotion would repair much of the equation, because top-flight broadcasting would return for 2027-28, and the club could carry its remaining installments against a much larger revenue base. Failure changes the calculation. The second parachute payment is smaller. Players held for the promotion campaign become a year older, and another season of operating costs consumes cash. By the third year, the support falls again, which is why relegated clubs often treat the first attempt as an emergency. That urgency can encourage more spending, even when spending is what created the fixed commitments causing the pressure. West Ham's position shows why relegation costs far more than the prize money lost on the final league table. A Premier League squad is assembled through contracts that reach several years into the future. The club promises wages and transfer installments because it expects television money to keep arriving. One bad season changes the revenue forecast immediately, while the expense schedule responds through clauses, negotiations, and sales over time. Parachute payments exist to manage that mismatch, although they cannot make every previous decision affordable. West Ham are therefore wealthy by championship standards and financially squeezed by Premier League commitments at the same time. Both descriptions can be true. The £196 million headline matters because it measures how much of future cash had already been promised before relegation. It should not be read as a demand for £196 million tomorrow, and it should not be dismissed as harmless accounting either. Around £111 million was originally classified as due within 1 year, and every payment has to compete with wages, interest, and the cost of trying to win promotion. West Ham's season is now taking place on two tables. One records points against championship opponents. The other records whether player sales, wage reductions, and shareholder support can arrive before the old Premier League bills do. Promotion is the result that makes the second table far easier to read. If it takes too long, the squad may have to be weakened until the finances fit the division. That is what relegation actually costs a Premier League club: control over the timing of its own decisions. That's it. That's all I have. Bye-bye.